Hello everybody, this is Jason Wink. Today is Friday, September 9th. It's my first post for the week. Just thought I'd do a video update for those who've been watching the market and had questions about what's going on. So you've all seen this chart before, but I've made it even more fun and complicated perhaps. I've added some green and some red lines that you can see on here. So you can kind of see those. See if I can get my highlighter here. So here's like the green and the red lines. And what those are, I just thought I would share a little bit some of the things I've been talking about in the last couple of weeks as far as, where the longer term momentum in the market is. And then, I've pointed out, different indicators of the momentum of the market. And so I thought this would give everyone a nice visual as well as some kind of number data as to why those things I've been watching are important. Essentially what these green and red lines are, so when you see the green and red lines, those are when these indicators I've been talking about, when they would trigger, for example, when it's time to get out of the market or when it would be time to get back in the market. And so looking at the last 15 years, this is not a precise study. It's only looking at two factors, and keep in mind we measure literally thousands of different factors at our firm. But this gives people an idea of some of the really big picture items as far as where we are in the current market cycle. So what I've been showing a lot of folks is things like where the shorter and longer term momentum is in the market. I've used a couple of different ways to point that out. And one of those is, for example, a moving average crossover. It's a little bit tricky to see because I'm guessing this video would be small unless you make it the full screen size, which I think you can do if you hover over the video. You'll see there's a little button. It looks like four arrows pointing out in different directions. If you click on that, it'll make it the full size of your screen, which may make this easier to see. But a crossover is essentially, we can see like this red line that kind of smooths out the general direction of the market. And what that is that's the 8-month moving average of the S&P 500. So it's close to 240 days for the average price. And so it's going to help smooth out the shorter term ups and downs. And then really close to the actual line, you can almost barely see it, is a black line. That's actually just a 2-month average. And so it just kind of smooths out the last 2 months average price again to take some of those really short and quick ups and downs and smooth those out. So this little illustration, what it's showing is what would happen if you used that when the short-term averages start falling quicker than the longer-term averages, and then you validated that by also looking at this, what we call moving average convergence and divergence. So I've shown this chart before, where kind of again shows the longer-term averages. And when they both kind of agree with each other, they both either say, hey, they think the market is in an upward trend, there's a lot of upward momentum, or conversely, they think there's downward momentum. Now, in the last 15 years, I threw some stats on this chart. And what you'll find is that if someone used any more complicated than this, it was very, very simple, and they only checked this at the end of each month, so that's something that would take maybe 5 minutes per month to check. If they use that as sort of their tell when the market looks like it's going to go down, and that's when they exit the market. And then the opposite is true when they see that the averages start going up, like we see here when this green line, they confirm each other. That's the entry point. That's when someone says, okay, I think the market's safer anyway, I should be invested. Well, when that's the case, what you find is that there would have been a total of 9 total transactions the last 15 years. So not really a super active trading program or anything like that, just very basic and simple. What we found is that back in the mid-90s, would have said that the market was fine and healthy and everybody would have been hunky-dory, making great returns. There would have been one little blip here where it would have said it gave a sort of a warning, and then just a couple months later, it gave a confirmation that the trend was still alive and well. So there would have been a little bit of a miss here. But then the market resumed its upward trend. But another warning sign here, this was in October of 2000. Of course, that would have been a good warning sign because it would have helped someone avoid essentially a roughly 45% or 40% decline. The next confirmation of the uptrend would have happened in May of 2003. Of course, the market rallied for some time. You can see that I put the numbers down here, about 35% gain. Would have been another one of these shorter term sort of head fakes, we'll call them, where thinks maybe the market's going to go down, ends up being just fine. So again, it misses a few percent of the upside there before resuming the rest of that uptrend. And of course, it gave another really nice warning here, and that was the 2008, sort of in November of 2008, or 7, excuse me, and would have stayed completely out of the market the whole year of 2009, and then missed the first few months of the recovery, but ultimately avoiding roughly a 40% decline again. Then gave the confirmation things were all in well in August of 2009. From August of 2009 till today, there's been roughly an 18% gain. Now, the reason why I'm sharing all this is that right now we're in the middle of September, so it's September 9, not even quite the middle of the month. So there would be no action that anyone would take in the middle of a month if this was their simplistic sort of system that they were using to protect their portfolio. But what we'd find is that if the month ended right where we are today, both of these momentum triggers are now triggering what would be a sell signal in this type of a timing mechanism. I know people have heard that you can't time the market, and there's been arguments back and forth on that, but the fact is that this to me validates in the last 15 years, absolutely people can time the market, and in fact it's incredibly smart to do so. If you avoid those really major, huge losses, it will help an investor significantly. You can see just this very simple mechanism shows that over the last 15 years, the buy and hold investor would have roughly doubled their portfolio over 15 years, which is roughly a 4.5% return per year. Whereas having a simple timing mechanism, and this is not again, assuming there's no commissions when you buy and sell, and it's not factoring in taxes if you have a taxable account, just the regular old total return would have been 264%. So again, over 15 years, that's in excess of 10% a year, so more than double the return. In fact, about 150% more return over the last 15 years. So very, very valuable to have some mechanisms in place. Now, things I should point out, though, is that there's a number of times when it's still in its what I call the buy phase, the green phase of the market, that there's still some drops. So there was a 20% drop last summer, and this particular view of looking at when to be in or out of the market would not have triggered any type of a sell. And of course, the market recovered from there and ended up going to a new high. And even today, the market's trading about the same as it was before that 20% decline last year. So having some type of system doesn't guarantee that someone will never have losses, and it also will show that there's sometimes when it would have told you, hey, get out of the market, but just a couple months later would have told you, oh, you know what, you should be back in. And when it does that, it misses some of these little upswings. You can see those here. Now, the good news is that the avoiding of the losses is far more valuable than missing the short-term gains when you come out and then back in. But again, where we're at today, this is why I've been talking so much about we have to give the market a little bit of time. An investor just needs to be conservative. And I know it's painful, but it's okay to have at least a portion of this drop. So the market today is actually close to its low for the year. I've shown just a little quick, Google Finance snapshots. This kind of gives us our up-to-date what's happening in the middle of the day. So refreshing this chart here, you can see that most of the stock market indices are down 1.5% to 2% or more for the day. And if you look at other investments like small cap stocks and mid cap stocks and foreign stocks, some of those are down even more, in some cases significantly more. And if we look at where a lot of these things are year to date, most of them are getting close to their lowest points of the year. So when we look at, for example, the S&P, this is its year-to-date return. You can kind of see it right here, down 7.62%. But if we actually look at a lot of the other things, like, for example, emerging markets, and a lot of people have thought that international stocks are the place to be in places like China or India or Brazil. Well, those are down actually, again, you can see that up here, 15.6% for the year. And those who are in things like smaller company stocks, they're also down more than the market. Right now, 13.15% for the year. So a lot of equity markets are getting close again to their lowest point of the year, which was last achieved. The lowest point was actually on, looks like kind of early August, then went back and sort of got almost to those lows again in late August. And now here we are, 9th of September, close to the same spot once again. So the moral of today's story is that there's a good chance investors will want to take some action, but they may want to wait until the end of the month to do so. There's no such thing as any type of perfect system for knowing when to get in or out of the market, but I have also shared that our economic indicator that we use, which is called Recession Probability Analytics, or RPA for short, has also significantly weakened. It did that in August, but it didn't quite hit its trigger point, which looks like it may hit here in September unless all of a sudden we get a bunch of very positive economic news. So for now, again, what I would suggest for investors is that when we have days and weeks like this has been a bad week, I understand that we don't panic, we don't make any big, huge knee-jerk reactions to what's happening in the market, but we stay patient and realize that there are plenty of very good systems and indicators that will tell us when it's time to move out. May mean we take some short-term losses, and that's okay because we want to make sure that we protect our portfolio for the next time a bigger, longer-term rally occurs. Rallies like we found from 2003 till 2007, or like the one we had from 2009 till today, which has actually been running now about 2.5 years from its low point. So that's it for today. I hope everybody has a good weekend. I know there's a lot of things that are going on in the world. We had a jobs speech last night. Evidently wasn't well received because the market came out of the gates losing money. We also had a speech by Ben Bernanke yesterday that was essentially delaying the Fed even making any attempts at improving the economic conditions. I do think that's smart in the long run. The less sort of government meddling we have, probably the better we all are in the long run, even though in the short term, some people would like to see the Fed step in or like to see the government do something to try to make the stock market go up. All that external interference is only going to cause more problems down the road. So eventually our economy has to face the music. That government can't bail it out forever. Just not enough money to do that perpetually. I think one of Obama's big things was a reduction of payroll taxes. Well, if you're a small business owner, I suppose that sounds wonderful. As most of you know, I own Retirement Wealth Advisors as well as a couple of other small businesses. And I suppose that would help me quite a bit. But at the end of the day, those payroll taxes are supposed to be funding a number of programs which are significantly underfunded. So as much as I think it might, again, seem like a great idea in the short run, I'm not sure how that helps solve our longer term problems. I mean, we can't put enough people to work to make up the shortcoming if payroll taxes are cut in half. So we'd have to have significant economic growth, and I think that's just kind of too big of a gamble to take. I know everyone wants there to be something going on, but again, I'm not sure that is the solution. So in the interim, again, we'll keep our very balanced and conservative portfolios. Probably towards the latter half of the month, we'll start sharing with clients what we're doing. But I'm going to go out on a limb and think that unless there's a big-time rally in the market, if it stays in this range, and I've shared before that getting above 1,200 was important, but it had to stay there. Well, it's not staying there. It's dropping, and now the S&P is down to 1162. So I think there's a halfway decent chance that it falls down to 1100 again. That's this longer term support line. If it goes there and lower, this could be another one of these longer term bear markets, and we want to make sure that we sidestep that as much as possible and perhaps even make some changes to profit in a climate like that for investors. So that's it for today. If you have questions, comments, anything like that, of course, use the comment field at the blog. And if you think this would be beneficial to anybody, again, I've reminded people in the past, I'm very appreciative. I have I've had about a 300% increase in the number of readers to my blog in the last 3 months. So I can only do that because people are sharing it. It's really great. So if you know someone you think might benefit, feel free to forward this to them, and maybe they can get some benefit as well. Thanks again, and have a great weekend.